Hello, and welcome to a new video of Explained for Dummies. Today we are gonna talk about the financial crisis of 2008. The origins of the financial crisis of 2008 can be traced back to the housing market. In the early 2000s, housing prices in the United States began to rise rapidly, fueled by low interest rates and lax lending standards. This led to a housing bubble, as more and more people bought homes they couldn't afford. Banks and other financial institutions began to create and sell mortgage-backed securities, which were essentially bundles of mortgages that were sold to investors. These securities were seen as a safe investment, but in reality, they were backed by mortgages that were at high risk of default. In 2008, the housing bubble burst, and many homeowners began to default on their mortgages. This led to a chain reaction in the financial sector, as banks and other institutions that held mortgage-backed securities began to suffer losses. One of the biggest casualties of the crisis was Lehman Brothers, a large investment bank. In September 2008, Lehman Brothers filed for bankruptcy, which sent shockwaves through the financial system. Many other banks and institutions were also on the brink of collapse. The collapse of Lehman Brothers and the wider financial crisis had a profound impact on the global economy. Stock markets around the world plummeted, and many businesses were forced to close their doors. Unemployment rates soared, and many people lost their homes and life savings. Governments around the world took action to try to stabilize the financial system. The U.S. government passed the Troubled Asset Relief Program, TARP, which provided hundreds of billions of dollars to help prop up struggling banks. Central banks around the world also took action to lower interest rates and inject liquidity into the financial system. Since the crisis, many changes have been made to try to prevent a similar event from happening again. Banks and other financial institutions are now subject to stricter regulations and oversight. Governments and central banks have also put in place mechanisms to help stabilize the financial system in times of crisis. However, there are still concerns about the stability of the financial system. Some experts worry that the low interest rates and high levels of debt that have characterized the global economy since the crisis could lead to another financial meltdown in the future. In conclusion, the financial crisis of 2008 was a watershed moment in the history of the global economy. It exposed deep flaws in the financial system and caused widespread damage to the lives and livelihoods of millions of people. While many steps have been taken to try to prevent a similar crisis from happening again, the future of the global economy remains uncertain. Thank you for watching this video, and we hope you found it informative.